Welcome back to another edition of Boss Economic World, the only place where we mix a hefty dose of economic theory with a splash of humor, a pinch of sarcasm, and a generous dollop of government. What were you thinking? Today's hot topic is none other than US President Donald Trump's offhand remarks about a potential fresh trade deal with China. Yes, you heard it right, in a move that could easily be the economic equivalent of, "Do I look like I care?" the ex-president hinted that a deal might be possible. Let's dive into this multi-layered saga where trade negotiations, tariffs, geopolitical posturing, and a dash of social media theatrics collide, creating a recipe that's as unpredictable as a caffeinated squirrel in the world of global finance. On a seemingly ordinary day aboard Air Force One, Trump remarked, it's possible," when asked by reporters about a potential trade deal with Beijing. And just like that, the global financial markets perked up faster than a trader on his third espresso shot of the morning. But before we start envisioning a harmonious trade utopia, let's peel back the layers of this comment. At first glance, the statement suggests a willingness, even openness, to negotiate. A hopeful note amidst the cacophony of trade war threats and tariff hikes. The president, who once imposed an extra 10% tariff on Chinese imports as a punitive measure against alleged unfair trade practices and the fentanyl influx, now seems to be warming up to the possibility of dialogue. In economic terms, tariffs are essentially taxes on imported goods. They are meant to protect domestic industries from foreign competition, but as we know, they can also lead to higher consumer prices, strained international relationships, and retaliatory measures by trade partners. When Trump doles out tariffs like candy, punishing China for its unfair practices, and then hints at reconciliation, it creates an environment of uncertainty. Markets love clarity, consistency, and for heaven's sake, a bit of predictability. Instead, what we're witnessing is a fluctuating policy stance that leaves investors wondering if today the president is the harbinger of economic stability or simply playing a dangerous version of tariff roulette. Let's take a stroll down memory lane. Remember the trade deal brokered in January 2020? Under that agreement, China had agreed to curb the theft of U.S. trade secrets and promised to boost its purchase of American goods by a dazzling $200 billion within a year. But, as fate, or perhaps some unseen economic force, would have it, the deal unraveled faster than a cheap suit during the initial outbreak of COVID-19. President Trump later placed the blame squarely on China for letting the virus loose on the world, a narrative that, according to many experts, was more political theater than scientific fact. Fast forward to our current moment, and we see Trump referencing that previous deal with a hint of nostalgia peppered with a dose of criticism. They had about $50 billion worth of our product, and we were making them buy it. The problem is that Biden didn't push them to adhere to it, he lamely quipped. This comment, aside from its historical inaccuracy, those numbers have been the subject of heated debate in trade circles, hints at a peculiar policy inconsistency. On one hand, you're dropping tariffs and hinting at deals, on the other, you're blaming the successor for not extracting every dime possible from a failing arrangement. It's as if one is playing ping-pong with policy, hoping that the ball eventually lands in an economically beneficial corner, but sometimes it just bounces off the paddle. When Trump's comment hit the airwaves, various market players immediately began recalibrating their risk assessments, an exercise not unlike trying to balance on a tightrope strung over the Grand Canyon. Let's break down the immediate market reactions. 1. Currency movements. The Chinese yuan experienced a modest rally, gaining 0.2% in offshore markets and 0.1% onshore. While these numbers might seem laughably small, imagine getting a 2-cent tip on a gourmet meal. For currency traders, even a 0.1% move is a signal. It indicates that, at least momentarily, the market perceives a potential thaw in US-China trade tensions. 2. Stock market adjustments. Chinese stocks reacted as well. The Hang Seng China Enterprises Index trimmed its losses, easing from an intraday drop of 2.4% to under 1.5%. It's like watching a roller coaster where, just when you think you're in for a heart-stopping freefall, the ride suddenly levels out. Investor sentiment, always the fickle beast, can shift on the back of a few select words. 3. Investor sentiment and speculation. Analyst Kun Go from ANZ Banking Group remarked that the barrage of social media posts, offhand comments, and interviews has now become the norm for Trump. The comparison to previous administrations isn't just rhetorical, it underscores the fact that markets are evolving in real time, processing not only hard economic data but also the aura of unpredictability that certain political figures exude. Let's now zoom out and consider the broader canvas. Behind the theatrics of trade negotiations lies a series of systemic issues that can be loosely tied back to poor policy management, a topic that gets many economists, including us at Boss Economic World, passionately fired up. Economic stability is built on the bedrock of consistent, rational policymaking. When policies waver like a flickering light bulb, one moment favoring protectionism with hefty tariffs, and the next, hinting at a potential trade deal, it creates an environment ripe for market volatility. Investors dread uncertainty because it erodes the predictability needed for long-term planning. Imagine budgeting your household finances only to wake up and find that the price of bread has quadrupled overnight because someone decided to meddle with trade policy. Not exactly ideal, right? The ongoing trade tensions have a cascading effect on global supply chains, an area that has already seen significant disruptions in the wake of the COVID-19 pandemic. The additional 10% tariff on Chinese goods has rippled through the economy, affecting not only large multinational corporations but also small and medium-sized enterprises, SMEs, that rely on affordable materials and components. A 2022 report by the World Bank estimated that such trade frictions could lead to a 0.5% decrease in global GDP, a seemingly modest figure until you remember that the global economy has barely recovered from the shocks of the pandemic. There's a fascinating political economy at play here. On one side, you have protectionist rhetoric aimed at winning votes by promising to safeguard American jobs and industries. On the other, you have the harsh realities of globalization, where supply chains are intricately interwoven and isolationism can lead to competitive disadvantages. Trump's comments on everything being possible reflect an inherent tension, the allure of a simple fix to a complex problem. If only negotiating a trade deal were as easy as promising everyone a slice of apple pie, right? Here's where our favorite target, the government's management, or mismanagement, of the economy, comes in. It's no secret that many economists argue that the policy pendulum has swung so wildly that businesses are left scrambling to adapt. Take, for example, the tech industry. For years, companies have invested heavily in research and development based on predictable trade relations. But with tariffs and potential trade wars clouding the horizon, those investments start to look riskier. In truth, such instability can lead to a spiral where consumer confidence drops, resulting in slower economic growth and, dare we say, a possible recession. Data from the International Monetary Fund, IMF, suggests that prolonged trade tensions could shave off nearly 1% of global GDP growth over the next 2 years, a chilling prospect that raises the question, are we engineering our own economic decline? Let's circle back to Trump's mention of the previous deal brokered in January 2020. The very notion that a trade agreement can be resurrected or reformed with a few pithy comments is almost laughable in its simplicity. If only diplomacy were as lightweight as tweets and sound bites. However, this simplicity belies a profound truth. Trade negotiations are a complex dance involving intricate economic calculations, competitive policy interests, and, let's not kid ourselves, a good deal of posturing. Think of it as a high-stakes poker game where both sides are bluffing, and the chips are made up of billions of dollars. Here we encounter a critical economic principle, the concept of game theory. In this context, each side, Washington and Beijing, has a set of strategies and payoffs, and every move, or misstep, can alter the delicate equilibrium. Trump's comment about a great relationship with President Xi is, on the surface, an olive branch. However, it simultaneously undercuts the very essence of a negotiation when mixed with punitive tariffs and contradictory policy directions. One could argue that this is akin to a chef who, when asked for his secret recipe, winks and says, "It's possible." But then proceeds to throw in ingredients at random. Adding another layer to this economic drama is the modern-day tool of social media. Gone are the days when trade negotiations were confined to closed-door meetings. Today, every comment by a head of state has the potential to move markets. As President Trump's remarks demonstrated, even a vague suggestion of renewed trade discussions can have immediate effects, if only by stirring speculative trading among investors. The markets responded, currencies adjusted, and indices oscillated up and down like a nervous ballet. The slight uptick in the yuan's value is a textbook example of market participants responding to potential policy shifts. According to the Bank for International Settlements, even minor changes in exchange rates can lead to significant capital flows in emerging markets. The Hang Seng China Enterprises Index's temporary recovery underscores how market sentiment can swing dramatically on the back of political rhetoric. A recent survey by the CFA Institute indicated that investor confidence in Asia increased by 15% on the news of potential de-escalation in US-China trade tensions. The IMF's projections, as mentioned earlier, reveal that sustained trade instability could potentially subtract nearly 1% off global GDP growth. For context, such a reduction would be enough to tip some developing economies into recessive conditions, a scenario that is already not far-fetched given the current global economic uncertainties. No discussion of this topic would be complete without a nod to the elephant in the room, the implicit comparison between the economic stewardship of Trump and that of his successor, Biden. When Trump criticizes Biden for failing to push China to stick to the deal, it's less an admission of policy evolution and more a classic case of, if it wasn't for me, political rhetoric. But real economic policy isn't a game of musical chairs, it's more like a multi-layered labyrinth where every misstep can lead to significant collateral damage. Consider this, while Trump's approach was characterized by a mix of unpredictable unilateral tariffs and grandiose claims of negotiation prowess, Biden's tenure has seen a more cautious, albeit sometimes indecisive, approach. The difference in these strategies has tangible effects. Recent data from the U.S. Bureau of Economic Analysis shows that despite Trump's aggressive measures, the U.S. trade deficit with China only narrowed by a marginal 3% in 2021, a sign that tariffs, while disruptive, are no magic bullet for trade imbalances. Meanwhile, Biden's administration, grappling with domestic challenges like inflation and supply chain bottlenecks, has struggled to mount a coherent counter-strategy that reassures both domestic industries and international partners. So, what's the bottom line? At its core, Trump's comment about the possibility of a new trade deal with China is emblematic of a broader malaise in today's economic policymaking, a constant flip-flop between protectionism and globalization, between unilateral action and multilateral dialogue. It's the economic equivalent of trying to mix oil and water, with a whole lot of explosive potential. Key takeaways. Financial markets are extremely sensitive to even the smallest hints of policy change. A mere, "it's possible," can move currencies and stocks, illustrating the fragility of investor confidence in these unpredictable times. When a government oscillates between protectionist measures and diplomatic overtures without a clear, coherent strategy, it sets the stage for long-term economic instability. This policy pendulum not only undermines confidence among domestic investors but also shakes the very foundations of global trade. Beyond the headlines and Twitter storms lie tangible impacts on industries, supply chains, and ultimately, the everyday consumer. Higher tariffs can mean higher prices at the checkout, while unpredictable trade policies can stymie innovation by discouraging long-term investment. In an era where every comment by a political figure can trigger market movements, the blend of politics, economics, and social media has created an environment where clarity is a commodity in short supply. Analysts and investors alike must navigate this minefield with caution, aware that a single offhand remark may well dictate the direction of global finance for days to come. So, where does this leave us? As ordinary viewers and professionals alike watch the interplay of economics and politics, the call for coherent, steady, and scientifically backed economic policies has never been louder. The potential for a new trade deal with China remains shrouded in vagueness, and, it's possible, that could either herald a new era of cooperation or set the stage for renewed economic skirmishes. The key, as always, is to balance protectionist measures with global economic realities. Governments must move beyond simplistic blame games and adopt policies based on sound economic principles, policies that consider both the short-term market fluctuations and the long-term structural shifts in the global economy. If only trade negotiations were like the classic Art of the Deal bestseller, where a few well-chosen words could magically resolve decades of economic friction. Alas, reality is far more complex. We're not merely dealing with black and white figures on a balance sheet, we're navigating a labyrinth of political ambitions, historical grievances, and global dependencies. In the end, if the current state of affairs teaches us anything, it's that we must be vigilant. Vigilant of markets, vigilant of policy swings, and most importantly, vigilant of the narratives spun by those at the helm. For in the world of economics, as in life, clarity and consistency are the currencies that truly matter. And so, as we continue to watch this high-stakes poker game between Washington and Beijing, let's remember, every offhand comment, every seemingly innocent tweet or soundbite, might just be the opening move in a grand game where the stakes are nothing less than global economic stability. This is Boss Economic World signing off with a reminder, when your economic future is being shuffled like a deck of cards, it pays to know your Trump from your tariff, and your macro from your micro. Stay witty, stay skeptical, and most importantly, keep your eyes on the data. Thank you for tuning in to this in-depth economic commentary. Whether you're an avid follower of finance or a professional in the field, remember, behind every seemingly casual remark lies a labyrinth of economic policies and political maneuvers waiting to be unraveled. Until next time, keep questioning, keep analyzing, and above all, keep laughing in the face of economic uncertainty.